On June 1st, 2023, in a major structural shift, the United Arab Emirates officially implemented a formal corporate tax regime. This move served two distinct purposes: aligning domestic policy with international tax transparency standards and maintaining the country's economic competitiveness. To understand the mechanics of the system, we have to look at the math. The corporate tax calculation here is an integrated process, built directly on existing financial data. The starting point is always the company's standard accounting profit, strictly derived from IFRS or IFRS for SMEs frameworks. From that starting point, the process moves through three structural pillars: identifying the entity classification, calculating the taxable base, and imposing the precise tax rate. The statutory logic governing how revenue flows through these pillars is dictated by Federal Decree Law No. 47. Mastering this law means knowing exactly how to filter raw accounting profit into a final sovereign tax liability. The first step in this framework filters the businesses themselves. Not every commercial activity in the UAE reaches the corporate tax level. For natural persons operating as sole proprietors, the law sets a strict compliance threshold. If their gross annual turnover is 1 million dirhams or less, they bypass the corporate tax pipeline entirely and are exempt from registration. The rules shift when assessing unincorporated partnerships. Rather than taxing the partnership as a single corporate entity, the state applies a see-through concept. The revenue passes completely through the partnership structure and flows outward, creating a direct tax liability for the individual partners. Conversely, foreign entities that are effectively managed and controlled from within the UAE are caught by the net and treated identically to domestic resident persons. The legal structure of a business directly dictates whether its revenue enters the corporate tax machinery or legally bypasses it. For entities caught in the net, the calculation begins with standalone financial statements prepared under accepted accounting standards. The state then applies Article 20 of the Decree Law to isolate the true taxable base. This article acts as a mechanical extraction tool, requiring specific statutory adjustments to strip non-taxable elements out of the gross accounting income. The most critical protective mechanism for corporate groups in this process is the participation exemption. To prevent double taxation on corporate profits, this exemption legally slices away dividends and capital gains earned from qualifying subsidiaries. Once those exempt capital receipts are removed, the fully taxable revenue receipts compress together to form the final adjusted base. By the time Article 20 is fully applied, standard accounting profit and UAE taxable income diverge completely. The state also deploys strict limits on expense deductions to prevent the artificial erosion of this taxable base. The UAE has embedded the OECD's BEPS Action 4 rules directly into its domestic framework. Under these rules, businesses can no longer claim unlimited deductions for net interest expenses. This chart models the new restriction. Interest deductions are strictly capped by a hard line at 30% of adjusted EBITDA. However, a safe harbor mechanism exists for SMEs. Net interest expenditure under 12 million dirhams bypasses the 30% limit, remaining fully deductible. If a business exceeds this cap, the disallowed interest is not permanently lost. It can be carried forward and deducted against profits for up to 10 subsequent tax periods. The law also includes an absolute anti-abuse ban. Interest on related party loans yields zero deduction if the transaction was structured purely to gain a tax advantage. Secondary deduction caps apply to operational costs. Entertainment expenses are restricted to 50%, while penalties, illicit payments, and recoverable VAT are strictly non-deductible. Aggressive debt loading and inflated operational expenses cannot be used to artificially deflate taxable income in the UAE. With the taxable base finalized, the system applies the statutory rate multipliers. For standard mainland juridical persons, the rate remains flat at 0% for the first 375,000 dirhams of income. When revenue exceeds that threshold, the rate sharply steps up, applying a flat 9% tax to every additional dirham. A parallel ecosystem exists alongside this mainland framework, the qualifying free zone person. Entities operating within a free zone can retain a 0% rate on their qualifying income, preserving the economic utility of these zones. But this status requires audited financials, strict adherence to arm's-length pricing, and maintaining adequate state substance. Failing any condition instantly revokes the 0% status, locking the entity out for the current and next 4 tax periods. The 0% free zone rate is a highly regulated privilege, requiring perfect operational compliance. Once the theoretical calculations are complete, the Federal Tax Authority mandates a strict execution window. Tax returns and their corresponding payments must be submitted no later than 9 months from the end of the relevant tax period. This timeline slider illustrates the rule. For a standard financial year ending December 31st, 2024, the absolute final deadline for filing and payment hits on September 30th, 2025. Within this 9-month window, all supporting documentation, from standalone IFRS statements to detailed transfer pricing reports, must be fully prepared. The compliance journey requires accurately classifying the entity, isolating the base, and filtering accounting profit through the rules of Article 20. It demands active navigation of the 30% EBITDA deduction guardrails to avoid unexpected tax exposure. By mastering the mechanics of Federal Decree Law No. 47, financial leaders translate corporate strategy into a compliant, optimized sovereign tax regime.